What's up? It's Controlled Trades, and in today's video, I'll be discussing shorting and the GameStop situation. So before we get into the nitty-gritty of what shorting is and how it relates to the stock market, I'm going to give you guys a real-life example that will hopefully help you visualize the concept of shorting. So let's say my friend named Johnny just bought a new $200 bike. My neighbor named Ralph is looking for a very similar bike. What both of them don't know, but what I know, is that there's a sale on bikes at my local bike shop. So what I do is I ask Johnny to borrow his $200 bike and I sell it to Ralph for $200. I now go to my local bike shop and I buy the same bike that Johnny let me borrow for $150. And remember, Ralph gave me $200 for it. I only am using $150 to buy this new bike. So I'm pocketing $50 in profit. Now I return this new bike to Johnny and everyone's happy. Johnny has his bike back. I got $50 of profit and Ralph has a new bike, right? So let's discuss shorting when it comes to stocks. Rather than investing where you're buying shares of a company because you think that the stock price will increase over the long run, shorting is where you are betting against a company because you think the stock price will decrease in the long run. And it's the exact same case as the bike. You are going to sell shares at a higher price with the hopes of buying them back at a lower price. Obviously, you can't sell thin air in the market, so you're going to need to borrow shares to even short in the first place. So in order to short a stock, I first need to borrow shares from another investor, and then I'm going to sell these borrowed shares on the market, and I'm going to receive money for that sale. And remember, I am borrowing these shares. I'm not given these shares to keep, and I'm not stealing these shares. I'm borrowing them. So eventually, I'm going to have to buy back these shares from the market and return them to the person who lent them to me. So there's two outcomes when you short a stock. You either make money or you lose money. So let's discuss how you would make money. You would make money if the stock price decreases. If I sell these shares, let's say for $10 a pop, and then the stock price decreases to $5, I can buy those shares back at $5, keep the $5 difference in price, and return them back to the person that lent me them. If I'm losing money, that's because the stock price is increasing. So if the stock price says go from $10 to $15, right? Then I'm going to lose money because I may have sold them on the market for $10 a pop, but now they're $15 and I'm going to buy back these shares at a $5 loss. I'm going to need to use $5 of my own money to buy back these shares so I could return them to their owner. And you may be asking, why don't I just wait until the stock price goes back lower under $10? And the reason being is because when you short a stock, the losses are technically unlimited. It can go to infinity. The stock price can keep going up and up and up and up and up and up and up. So there's a point when short sellers want to limit their losses, so they have to buy these shares back to give them to the person that lent them. So let's discuss what a short squeeze is. And a short squeeze is essentially what caused a dramatic increase in price in GameStop's stock over the last week and what's causing all this frantic mayhem on the news and on Wall Street, etc. So, like I said, if the stock price rises, the short sellers are going to look to cut their losses by buying these shares back so that they can return them. What happens when these short sellers buy these shares back is it creates kind of like a domino or a cascade effect. When the short sellers buy these shares back, that increases the stock price. And then now, because the stock price is increasing, other short sellers now have to cover their loss. And it's kind of just like a loop until all the short sellers have covered their losses, right? So it can get to a point where there's a buying frenzy because as that stock price goes higher, the more short sellers are forced to cut their losses by buying back the borrowed shares that they sold. So in the case of GameStop, it's a kind of unique situation because there were more shares being borrowed than are available to be publicly traded. I'll discuss how this is possible in another video, but there's more demand than there was supply because when the short sellers did have to start covering their losses, there weren't enough shares for them to buy back to return to their lenders, and that increased the stock price exponentially. So let's discuss the GameStop situation. So institutions on Wall Street were short selling GameStop shares, and they were heavily shorting GameStop to where they shorted 140% of the shares. So not 100%, but 140% of the shares. They were shorting more shares than were available on the market. Like I said, I'll explain this in another video, but as a result of this Reddit group called All Our Wall Street Bets seeing this, they realized, hey, if we buy enough shares and we hold, we can demand whatever price we want for these shares, right? Because the short sellers are eventually going to have to cover their losses, but they can't buy back shares if everyone's just holding. They need to find people who are willing to sell them shares. And our Wall Street Bets was like, hey, if we buy and hold and push the stock price up, it's going to cause short sellers to cover their losses, but they can't cover their losses without the shares. So it's kind of like if you were to hold a hostage ransom, right? Our Wall Street Bets is holding their shares ransom. If you hold a hostage ransom, you can demand whatever money, whatever amount of money you want until you get the hostage back and the person's willing to release the hostage. The same thing for our Wall Street Bets. They were kind of holding the shares ransom per se, and they were demanding higher and higher and higher and higher prices for these shares until they finally were like, okay, this is good enough to where I want to sell. And like I said, that's basically what happened and what's causing the drama on Wall Street right now. Institutions are having a hard time finding available shares so that they can return the shares to the lenders that they borrowed from. And because there's no available sellers, the institutions who borrow the shares are having to up the prices that they're willing to pay higher and higher and higher just to entice the sellers until individuals are finally willing to sell. And if you go on the R Wall Street Bets subreddit, you can see that most of the people on there are saying hold the line. They don't want them to sell because in theory, if no one sells, institutions just keep having to raise the price higher and higher and higher and higher until someone finally cracks. But obviously people are going to take profits, so institutions are slowly going to start covering shares, but you have institutions who are still standing their ground and are not willing to sell yet. It's gotten so bad that one institution, Melvin Capital, is on the brink of bankruptcy because of how much in losses that they have taken on. So hopefully this kind of cleared up some of what was happening in the world right now for you guys. If you guys like the video, leave a like, subscribe to the channel if you guys would like to see further content on the stock market, and just comment any feedback or future topics that you guys would like me to cover. I appreciate you guys watching the video. I'll see you next video.